Hello, everybody. You are joining us today on our monthly Wednesday webinar series. We appreciate you taking your time out this morning to learn about two different things: independent contractors versus employees, how to make sure you don't get fined for classifying them incorrectly, as well as employee retention credits. Who qualifies and how do you claim them? It's a very important topic right now. There's a lot of confusion, and we're lucky to have George and Jessica here of ConnectPay Payroll Solutions to explain all this to us. We have a short period of time, so I'm just going to do a brief introduction so that they can get at it. So George Heidelmaier, sorry. You have over 15 years in payroll experience in the space of payroll. You're currently the district manager of ConnectPay Payroll, and he's a past owner of It's Payday. And Jessica Winter is also joining us today. She's a committed and experienced sales professional. She specializes in payroll services with ConnectPay. She works with business owners closely to make sure their payroll solutions fit their needs now and for their future. So that's all that I'm going to say, so I can hand it over to you both, and you can get started on your presentation. So thanks again for joining us on our monthly webinar.
Thank you for having us.
Well, thank you, Kathleen, and thanks for having us. As Kathleen said, we're going to talk about 1099s versus employees, and we're also going to touch on ERTC, which is employee retention tax credits. I'm going to go first, and I'm going to talk about the employee retention tax credits, if I may, and then Jess is going to follow and talk about 1099s versus employees. So I don't know how long everyone's been in business, but if y'all were in business back in March of 2020, it was a very, very scary, creepy, eerie time. Being in the payroll processing business and focusing on small to medium-sized companies, we really struggled because a lot of our clients were forced to shut down. A lot of our clients are hands-on, meaning, like a massage envy. A lot of them are restaurants. A lot of them are individual companies who deal with other individuals. So I think you can remember how freaky it was. A lot of those companies were shut down temporarily, and they were forced to just hang out until they could open back up. So it was really kind of a weird time. Back at that same time, the federal government rolled out a program called PPP, which was the Payroll Protection Program. They did that so that businesses could get low interest rate loans, and so that they could try to weather the storm that this COVID had created. The problem with the PPP loan is the loan program is nobody knew anything about it. They rolled it out, and bankers, quite honestly, were apprehensive to try to help business owners. Accountants were, it was this time of the year where they're in their peak of their tax season, and they're like, we can't be bothered with it. So, the payroll company oftentimes are the stepchild, and a lot of it got kicked down to us to try to figure out and try to help our clients with. The ERTC is very, very similar in that it's confusing, and being the stepchild, a lot of accountants and a lot of professionals out there say, well, contact your payroll provider. They're the ones that can help you. The ERTC program is something that if you are eligible for, I strongly suggest that you, I hate to use the word take advantage of, but you deserve this program if you're eligible. However, it's not one person's responsibility to help you to navigate through this process. It's a combination. It's going to be your bookkeeper. It's going to be your CPA. It's going to be your accounting team. And as I go through this presentation, I can show you how all 3 or 4 of those folks play a very integral role in A, establishing if you're eligible for the credit, and B, helping you to get there. So as this slide says, the Employee Retention Tax Credit is a federal tax credit that was established by the CARES Act of 2020, enhanced by Consolidated Appropriations Act of 2021. So the ERTC has undergone numerous changes and clarifications. So I'm going to be talking about different numbers in different years, and I may screw up some of the years, but just try to follow me, because the requirements to qualify for the ERTC program have decreased, and the amount of money that a business can get has increased, which is a good thing. So how does all this work? So the ERTC program is designed for small businesses to reward them and try to upright them for having employees on payroll through, the pandemic. So the credit can be claimed on wages between March 2020 and September 30th of 2021. So how do you even start to determine if you're eligible for this credit? There's a couple different ways in which you can become eligible. What you need to do is, as I said earlier, along with your bookkeeper or your accountant or your whomever, the first thing you need to determine is, am I even eligible for this credit? So as I said earlier, the requirements have decreased in 2021, and the available money back to the employer have increased. So here's an example. Gross receipts, or let's just say that what it is, how much money did you make in a specific time? So the federal government goes by quarters with payroll processing and many other things. You have first quarter through fourth quarter. It's January, February, March is the first quarter, et cetera, et cetera. So how do you determine if you're eligible for this credit? You need to look at your gross receipts, or how much money you made in a quarter of 2020, and compare that to the same quarter in 2019. So here's an example. I'm going to look at Q2 of 2020. In Q2 of 2020, I made $50,000. In Q2 of 2019, I made $200,000. I had a substantial decrease from Q2 2020 to Q2 2019. So therefore, I have passed the first step. I am now eligible to take a look at the wages and move forward. Now, in 2021, in the infinite wisdom, the IRS or whomever said, maybe the decrease of 50% was a bit high. We're going to drop that down. And now we're going to say, for gross receipts, or how much money you made in 2021, compared to the same quarter in 2019, now we only need to see a 20% decrease. So example is, you look at Q2 in 2021, you made $100,000. You look at Q2 in 2019, you made $70,000. You are showing a 30% decrease in Q2 of 2021 over Q2 of 2019. So you therefore are eligible to go to the next step. There's also another test that you'd have to get clarification from a CPA or a bookkeeper. It corresponds with the decrease, but also if you guys remember, there was businesses that were shut down by government order, right? It's the restaurants where it's like, oh my God, we can't sit at this table, or you can't go here. So if your business was partially suspended by a government order, and that's documented, that also could help with eligibility. So it's also worth noting if you've gotten PPP loan money, as I said earlier, that's the Payroll Protection Program. If you've gotten PPP money, there was, as you remember, there was a first draw and a second draw. The eligibility to get the second draw of the PPP money also sort of correlates with the ERTC eligibility. So if you were eligible for the second round of PPP, pretty comfortable to say that you're eligible for the ERTC, but again, you still have to do that gross receipts test and you need to look to confirm that you did indeed have that decrease. Now, I want to back up a second and say that it's really kind of scary because the IRS does not require you as the business owner, when you apply for your credit, to show any kind of documentation that you indeed did have that 50% decrease in 2020 or the 20% decrease in 2021. You basically are just self-attesting to the fact that, yes, we are eligible and we're moving to the next step. A word of caution with all due respect to some companies that are popping up there, and you probably, when I say this, you're going to hear these ads all the time. You may not have noticed it, but you are eligible for this. You could qualify for that. Just be very, very cautious with all due respect of those folks who they're taking a percentage of your credit and they're also qualifying you for the credit, which means they're going to do their damnedest to make sure that you're eligible. They're going to say, let's move to the next step. You don't need to send any documentation in, but Lord forbid, should you ever be audited 3 or 4 years down the road, and you don't have the documentation to indeed show that you had that decrease. However, the company that did the work for you qualified you. So just be careful with that. Can we go back one, I think? No? Okay. So back to how some of the requirements and the monies and the things have changed. Back in 2020, I guess the IRS was a bit more stringent and a bit more tight with the money and the requirements. So in 2020, as I said, you had to show a 50% decrease in wages, and then you were eligible. If you determine that you had that decrease, you were eligible to get 50% of $10,000 of wages per employee. So what does that mean? That means that if I determined in 2020 that I had a 50% decrease and my employee Jessica made $10,000 in that second quarter, I am eligible to get a refund from the federal government of 50% of that $10,000 or $5,000. I can do that for as many employees as I have. $10,000 cap, 50% refund of that $10,000. Now, and I apologize, I think this is a typo on the slide. 2021, you show that decrease from 20% versus 50% in 2020. We are now eligible for 70% of Jessica's wages per quarter. Again, 2020 was 50% of 10,000 for a max of 5,000. In 2021, if Jessica made $10,000 per quarter and I qualified for every one of those quarters, we are eligible for 70% of that $10,000 or $7,000 per quarter for a total of not $26,000 but $28,000 annually for Jessica's $40,000. So how do we do this? Back in the creepy days of COVID, when it first happened, the IRS said, fill out this form and fax it in, and we will magically send you the money. Well, they did that for the first couple months, and then they said, no, this is lunacy. So in the payroll business, businesses fill out a form that's called a 941, and that is completed and sent in on a quarterly basis. What we do, or what you need to do, is after you've determined the qualification, if you're qualified, you need to look at the wages and see how much each person made in that quarter. Then you need to have your payroll provider complete a form called 941X, at which point that form it has to go snail mail. It's sent to you, you sign it, you send it to the IRS, and they issue you a credit based on your calculations. They were saying it's a 90-day turnaround. I've seen it take up to 9 months to a year. But if it's money that's coming your way, I would wait that long for a nice refund. So along with a lot of other good things that happen in life, a lot of bad things happen. There's a lot of fraud that's going on with this, where companies are sending in 941Xs, fraudulent folks are sending them in. So there is going to be probably a fairly substantial amount of audits done on this. If you do qualify, you actually do deserve this money. So I would encourage you to take advantage of it. So in conclusion, this says that the ERTC is a valuable resource for small and medium-sized businesses. And it truly is, because we as small business owners, we weathered the storm, and we did a lot. We borrowed money to pay people, and we did a lot of difficult things. So this actually is a very valuable program. And again, I would consult with your bookkeeper, your accountant, your payroll processor, and anyone else that can help you with the factors that I discussed. Thank you.
Thank you, George.
Thank you.
So now we're going to take a little bit of a detour and talk about employee classification. While there are many different forms of employee relationships, they commonly boil down to either independent contractor or employee. Today, we're going to take a deeper look into an independent contractor and what differentiates him from an employee. So over the years, the statutes for independent contractor classification have been based on what was called the 20-factor or right to control test. In 2019, the IRS stopped using the 20-factor test, citing that it was too complicated to apply. So it was compressed into what we use today, which is commonly referred to as a three-pronged common law test. It is important to note that this may be state specific, so please contact the IRS or dive a little deeper, your payroll provider, whomever, to determine which classification is being used in your state, as the 20-factor test may still be applicable. Today, we're going to talk about the common law test and its three prongs: behavior control, financial control, and relationships of the parties. Starting with behavior control, an employer should ask himself, do I influence where and when my employee or employees complete their duties? And there are a few questions that one may use to break this down even further. So questions similar to what type of or how much instruction will the position require? Does this position require a set schedule? Is there a dedicated evaluation system or performance assessment for this position? And does the position require ongoing or periodic training? A great rule of thumb here is if the role requires little to no instruction, can be completed on an as-needed basis, utilizes individual skills not to be evaluated annually, and does not need much training aside from what the hire specializes in, then this can be considered a good fit for an independent contractor. If these characteristics do not apply and they really need to have in-depth training and a set 40 hours a week at a desk, then they're probably an employee. The second prong is financial control. Important to note, an independent contractor needs to be paid more than $600 a year in order to qualify for 1099 status with the IRS. Aside from this distinction, the employer should consider how much of the economic aspects of the position need to be managed. This concept can be quite substantial. So the IRS has provided 5 factors to use in assisting the employer in this decision. The first is there a significant investment? Independent contractors typically invest more of their money on tools or equipment, giving them a greater chance for incurring a loss over the employer. If this is not true and the employer stands to absorb the most risk, this is a role best suited for the employee. The second factor is, will there be unreimbursed expenses? A very good rule for classification applies with reimbursed expenses. Typically, an independent contractor reimburses most, if not all, job-related expenses. If the employer plans to expense items or reimburse worker after job completion, then this is a key indicator of an employee. The third factor is the opportunity for profit or loss negotiable? Independent contractors often have autonomy to negotiate a contract or a bid for more or sometimes even less pay, meaning there are no set wages. Set hourly or salary wages typically constitute employees. The fourth is, are the services available to market? If there's not a contract set out or a do not compete, then the employee is free to market his or her services to multiple companies. Then this role is pretty much an independent contractor. Employees are often held to standards of conduct and employment as outlined in contracts loyal to one employer. And the last one is, what is the method of payment upon completion of the job? If payment is rendered in one lump sum at completion of the job or requires submission of invoices for payment, this is often best described as an independent contractor. If the role offers regular and consistent paychecks, that is best decided for an employee. The third and final prong is the relationship of the parties. It is a good best practice for any employer to take a deep dive into the potential employer-employee relationship, specifically 4 key areas. There's written contracts, employee benefits, permanency of relationship, and services provided. So when writing contracts and employer relationship, it is important to note that the employer must pay close attention to the verbiage used. Details and language can be a deciding factor. So regardless of the author's intent, meaning using the term employee as a blanket term can become legally binding. In regards to benefits, if an employer is offering benefits of any sort, healthcare, retirement savings, paid personal time off, etc., this typically constitutes an employee status and relationship. The permanency of the relationship is pretty self-explanatory. If the employer is hiring for a role that has a set time frame or clear start and end points, this is typically associated with an independent contractor. Think of someone coming to paint your house or a roofer or coming in to just do some sort of plumbing work. If the role has no clear end date or an option to renew or extend a contract's term, this is associated with an employee, i.e., an administrative assistant, someone sitting at a desk, or a sales representative. So now we're going to take a little bit of a deeper dive into an independent contractor and let's look briefly at what constitutes an employee. There are some relationships that are more typical in an employer-employee relationship, so we're going to discuss that. Thank you. In traditional relationships, the employer pays the following taxes. So it's going to be an even split in an employer-employee relationship. The employer is going to pay Medicare, Social Security, unemployment, and income taxes. Independent contractors pay both sets of payroll taxes at the end of the year. Employers typically offer employees health benefits, retirement savings, personal or sick time off, vacation pay, overtime or bonuses, quality training, or continued education if required. While costly, offering these to employees have a variety of benefits to an employer, including, but not limited to, attracting and retaining top talent, employee loyalty and tenure, a happy and healthy work environment filled with thriving individuals working together as a cohesive team. It is important to note here that a positive work environment treats employees as an internal customer and does what is necessary to retain them alongside the external ones. This ensures overall satisfaction, referrals, loyalty, and most importantly, drives top-line growth for the business. There are benefits for hiring an independent contractor that we didn't already discuss. So we talked a lot about what makes it sense to have an employer-employee. What makes sense for an employer to hire an independent contractor is there's no need to pay out vacation upon termination. The individual usually specializes in the field that he or she is hired in, so there's less time or money that needs to go into additional training. There's lessened risk of legal claims and minimal expenses or overhead for the employer because the independent contractor is absorbing most of that. Common mistakes made when considering an independent contractor are not establishing a written agreement stating contractor's independent status, exercising too much control over schedules or tasks, and basing classifications solely on industry norms. In addition to that, it's failure to file the Form 1099 miscellaneous at the end of the year for any contractor who is paid more than $600 annually. And that is the basic overview of employee classification.
Well, George and Jessica, that was such a great presentation and so much information. Couple questions,
Thank you.
George,
Yes.
for the tax credit,
Yeah.
how much longer is this going to go on for?
It ended in 2021, meaning that was the last year that you could do the look back period. I think you have another year and a half to apply for the tax credit. I can get you a more firm answer on that, but there's no huge hurry, but I would definitely start looking at it.
Okay, great. And Jessica, with the contractor employee, W-2 issue, what are the fines if you are audited and fined that you did not classify them correctly?
Yeah, you had mentioned it earlier. So there could be a lot of things, but specifically up to a $500 fine if you're not doing that, and a lot of other ways that can come back. So I didn't want to focus so much on the negative pieces of it here and just starting off in the beginning. But yes, you could be fined quite substantially per employee if you are misclassifying.
Okay, great. And is there a specific, like, let's say that somebody started as a subcontractor and then you're like, you're a really good worker, come work for me. Is there like a specific process that they have to go through, or is it just simply you just start them on a W-2?
Yep, it's pretty straightforward at that point. Once you decide you're going to change the classification, you would just begin the W-2 process and work through there. And again, you can reach out to your payroll provider, your accountant, or your bookkeeper if they have any other questions, but it is not difficult. It's more difficult and more costly to not switch somebody than it would be to actually switch them over.
Okay. And ConnectPay, tell us a little bit about what you handle both with the tax credit and the classifications and getting everybody situated.
So I'm not going to speak solely for George, but we can go through most of that. There's a lot of things we cannot do legally within the IRS for a potential client or customer, but that's not to say that we won't get on a three-way call and go through everything with them and absorb most of the pain for the client. We break it down. We take the time to ask everyone what their needs are, why their needs are such, to really understand what's driving the small business owner. Sometimes the answer is a 1099 independent contractor. Sometimes it's not, and that's okay. Our job is simply to ask for the right questions to get to the correct answer. As far as employee retention credits, we're here again as a trusted source, and as George said, it's multifaceted. So
you'll hold our hand, right?
Yes, exactly. Yes. Thank you, Kathleen.
We do have another question. Is there certain documentation you should get from a contractor to verify their status if you're audited?
Insurance.
Yeah. So, and the biggest part here is just going to be insurance. How are they insured? What are you insured for? What does that look like? And that's the first step. So you need to have all of that on file before you can move forward with having anyone. There's proper insurance forms. And at the end of the year, then there's additional tax filings for said contractor that they would do as well. 1099R or M, I believe, depending on how they're classified.
And the insurance is coming from that contractor. So
correct.
What exact insurance are you looking for? Like,
it would be their PNC insurance. Also, there's a form called a W-9 that you should have the independent contractor complete, stating that they are, independent contractor. Oftentimes, businesses want to just pay employees as independent contractors because they get away from, as Jessica said, the matching taxes, the 7.65 and the unemployment. However, if you are caught, it's a lot larger of a fine to pay than just doing the right thing from the beginning. And it's pretty self-explanatory. Jessica went through many great points, but I mean, we all know what a 1099 is and an employee. Do you give them a place to sit at your office? Are they required to come at certain times? Do you supply them with a computer? And that's how we can help. If there's some questions, we can talk through those things, and really, rather than going through an in-depth checklist, if you just bring up some of those things, oftentimes employers will say, well, yeah, I do give them a desk, or yeah, I require them to be here at 9 o'clock. So it just answers their own question.
Well, chock full of information. Thank you both for joining us on our monthly webinar series. Everyone on this webinar and those watching in the future, because this will be put onto our YouTube channel where you can go use it as a resource and share it as well. Please reach out to ConnectPay. They are very happy to help you and hold your hand in a lot of this. So George and Jessica are there for you. And again, we really appreciate you joining us today.
Thanks so very much for having us.
Okay, everyone, we will have our next webinar at the last Wednesday of next month, which I'm looking at my calendar now, which would be April 26th. So we will be having our next webinar. And again, thank you, George and Jessica.
Thank you.
Have a nice day. Thank you.
Okay, bye.
Bye.